All right, so we're going back in time today, like way back to July 2020.
Oh, wow, 2020.
Yeah, before GameStop was, well, GameStop.
Before the whole world knew about it.
Exactly. One of you sent in this YouTube video, a deep dive into GameStop stock by this guy, Roaring Kitty. It's like a time capsule,
Okay.
a snapshot of what at least one investor saw in GameStop when everyone else was like, nah, it's over.
Yeah, what's fascinating is that Roaring Kitty wasn't just blindly betting on it. They were looking at GameStop through this value investor lens, trying to find these hidden gems the market was missing.
Right, like those diamonds in the rough.
And honestly, they made a pretty strong case, even back then.
Yeah, I was surprised too. Like, they really dug into that whole narrative. The GameStop is the next blockbuster. Brick and mortar is dead. Digital's taking over thing. But they didn't just dismiss it. They actually looked at the data.
Exactly. They challenged that assumption that everyone was rushing to download games. They pointed out that in 2018, 75% of FIFA sales were still physical copies.
Wow, 75%. I had no idea.
Yeah, and they even found quotes from Xbox's Phil Spencer, the head of Xbox,
Yeah, of course.
talking about how millions of people still preferred physical games, even in 2019.
And this isn't just some random executive trying to save face.
Right.
This is the guy.
Exactly. Plus, Roaring Kitty even highlighted gamers themselves on YouTube, saying things like they like having a physical disc to trade in or share with friends. It's like, hold on, maybe this digital takeover isn't as inevitable as everyone thinks.
It definitely makes you think twice about jumping on the bandwagon. You know what I mean?
Absolutely. It reminds us that we can get caught up in the hype of a new technology,
Yeah.
assuming everyone's adopting it at the same pace.
Right. Like, and everyone thought we'd all be reading ebooks by now.
Exactly.
Okay, but even if the shift to digital was slower than some people thought, GameStop was still facing a ton of negativity back then. I mean, everyone was comparing them to Blockbuster, saying they were going to get crushed by Amazon.
Oh, yeah, absolutely. They dove headfirst into that negativity, calling out all those doomsday predictions. But then they hit back with some hard numbers.
Okay, like what?
Well, GameStop was still pulling in $6 billion in revenue at the end of a console cycle.
$6 billion. That's not exactly chump change.
No, not at all. It shows that they still had a decent customer base, a big chunk of the market share. And they weren't just fading away. They also used data from this presentation by Hester and Permanent.
Who are they?
They're an investment firm that was pushing for changes at GameStop at the time. And their data showed continued customer interest. So it suggested that maybe, just maybe, there was still some life left in GameStop.
So it wasn't blind optimism. They were actually finding data points that other people might have missed or just ignored.
Exactly. And that leads us to the core of their argument. Overlooked value.
Overlooked value, okay.
They saw a company that was trading for way less than what they believed it was actually worth. Plus, they were seeing positive changes, like a new management team focused on cutting costs and making smarter decisions.
Okay, but a new management team can be a good thing, but it doesn't always work out right. Did they explain why they had faith in this team?
They did. They highlighted how the team was focused on improving working capital.
Working capital.
Yeah, basically making sure the company had enough cash to, operate smoothly.
It's the lights on.
Right. And they said that GameStop had enough liquidity, meaning like available cash and assets that could easily be turned into cash.
So they could weather the storm, so to speak.
Exactly. And they could handle the upcoming console transition, which is a big deal because new consoles usually mean companies like GameStop have to spend a lot of money.
Makes sense. It sounds like they were looking for evidence that GameStop could not only survive, but actually do well in the new console cycle.
Yeah, and there's more. They also emphasized that GameStop still had this thing called operating leverage.
Operating leverage.
It means they could really boost their profits with even a small increase in sales.
Oh, interesting.
And at the time, get this, they were trading at just 4% of their revenue.
Oh, percent.
Pretty crazy, right? It's like finding a dollar bill on the ground and then realizing, wait, this is actually a 5.
I'm starting to see why you called them a value investor. They're looking for those signs that a company is worth way more than what the market thinks.
Exactly. And to really drive that point home, they actually walked viewers through GameStop's balance sheet. They highlighted their cash position, $570 million in cash against a market cap of just $260 million.
Hold on. So the market was basically saying GameStop was worth less than the cash they had in the bank?
It sounds crazy, right? But that's what they were pointing out.
Oh.
They also argued that GameStop's inventory was mostly made up of newer stuff,
Oh.
not just old used games.
So good quality inventory.
Yeah. They really broke down their assets and liabilities and estimated what's called their book value. Basically, what the company would be worth if they sold everything off and paid all their debts.
Okay, so kind of like a bare minimum value.
Right, and they estimated that to be around $400 million.
So even by the simplest measures, GameStop seemed undervalued. This is where things get even more interesting, right?
Oh, yeah. They didn't stop at the book value. They went ahead and built a model to project GameStop's future cash flow. But, and this is important, they used really conservative assumptions.
Conservative assumptions.
Yeah, they basically underestimated how well GameStop would do in the future to see if they could still generate value in, like, a worst-case scenario.
Okay, I see. So they were being extra cautious.
Right. They slashed the profit margin down to just 0.68%, which was way lower than their historical average.
Wow, so they were really stress testing the numbers.
Exactly. And they based their calculations on an estimated average revenue of $5 billion over 6 years.
So they were saying even if GameStop barely makes a profit and their revenue stays flat for the next 6 years,
They're still worth more than what the market thinks.
I'm starting to see why this roaring kitty person got people's attention. They weren't just saying GameStop was undervalued, they were backing it up with data.
And that's not even all of it. They had even more reasons to be bullish on GameStop, things that could make the company worth even more than those impressive numbers.
There's more. All right, well, I guess we'll have to wait for the next part of our deep dive to hear about that. Okay, I'm ready to hear about these extra layers. What else did they see in GameStop?
Well, they talked about this huge share buyback program. GameStop was buying back their own stock, like aggressively. They actually cut the share count in half since the last console cycle.
Yeah, I remember that part. But why does that matter?
Think of it like a pizza. You've got a whole pizza cut into 8 slices. Each slice is a share of the company, right?
Right.
Now, if you take 4 slices away, eat them, gone.
The remaining slices get bigger.
Exactly. That's what a share buyback does. Reduces the number of shares, makes each remaining share more valuable.
So even though the whole pizza, the company's value, isn't changing, each individual slice gets bigger.
That's a great way to put it. And Roaring Kitty saw that as another good sign. Like, GameStop was serious about making each share worth more.
Okay, so that's buybacks. What else?
They also thought a private equity buyout could happen. Like, totally possible. They pointed out there was almost an acquisition back in 2018, almost went through.
Yeah.
And since GameStop was so undervalued,
It was ripe for the picking.
exactly, some private equity firm could come in, see the real value, offer to buy the whole company.
And boom, big payday for anyone holding the stock.
Right. It'd be like flipping a house. You buy it low, fix it up a bit, and someone who sees its potential comes in with a much higher offer.
So we've got fundamentals, buybacks, potential buyout, anything else?
Oh, there's more. They even pointed out some extra upside that wasn't even in their initial valuation, like layers upon layers of reasons to be bullish.
Lay it on me.
Well, they talked about the possibility of, like, continued interest in physical games. Maybe the shift to digital wouldn't be as fast as everyone thought.
Didn't they already cover that?
Yeah, but this was about it lasting longer than expected. Like, even after the new consoles come out, their valuation was conservative. So any extra interest in physical games would be pure upside.
I see. So even if things didn't go exactly to plan, there was still room for things to go better than expected.
Right. And they also talked about higher margin revenue, like through partnerships with game publishers.
So instead of just selling games, they could, create their own bundles?
Something like that, yeah. Offer exclusive content, stuff you couldn't get anywhere else. Higher prices, better margins.
Instead of just plain coffee, they're selling those fancy lattes.
Exactly. And get this, they even thought about turning those test stores,
The ones they were trying out.
yeah, into like social gaming hubs, places for gamers to meet up, play together, have tournaments.
Oh, that's cool. Like a modern arcade, a place you actually go to.
Right. They saw that GameStop already had the customers in the stores. It was just about finding the right way to use them, adapting.
When you put it all together, it's pretty impressive. This wasn't just random speculation. They had a whole thesis. They did their research. It makes you wonder.
If it all played out how they thought it would.
Yeah. This video was from July 2020. And a few months later, well, GameStop went crazy. The whole world knew about it. Was Roaring Kitty just lucky? Or did they see the future?
That's the million-dollar question, isn't it?
Okay, so we've seen how Roaring Kitty basically dissected GameStop, like a detective with a magnifying glass.
Exactly.
But how do we use those lessons today? I mean, things have changed.
Oh yeah, for sure. Things are different now. But the core principles, those still hold up. It starts with changing how we think about the market. Roaring Kitty wasn't chasing hot stocks. They were hunting for value.
So instead of getting caught up in, like, the hype cycle, we need to be more, I don't know, analytical.
Well, totally. Like detectives, right?
Yeah.
Searching for those little clues that say, hey, this company is worth way more than what people think.
Yeah, like they did with those YouTube comments. Everyone was saying gamers were going all digital, but they found evidence that said, hold on a second.
Exactly. Question those assumptions. Look for evidence. Value investing isn't just about finding cheap stocks. It's about understanding what a company's actually worth, like their assets, their earnings, their potential to grow.
So it's like you see a house for sale, right? Don't just look at the asking price. Figure out what it's really worth, location, size, all that.
Exactly. And once you find a company that might be undervalued, then you got to look for catalysts. Things that'll unlock that value, like Roaring Kitty talk about the buyback program, a possible buyout, and even some new ideas for GameStop's business.
So it's not just waiting around. You're actually looking for things that'll make the stock price go up.
Yeah, like finding a treasure chest and then figuring out how to open it. But you got to be patient. Real value takes time. Roaring Kitty wasn't looking for a quick buck. They were thinking long term.
It's like planting a seed, right? You can't just yank it out of the ground and expect a tree.
Exactly. But of course, it's easy to look back at GameStop and be like, oh yeah, obviously it was undervalued. That's hindsight, right? The real trick is finding those opportunities now when no one knows what's going to happen.
So how do we do that? I mean, I don't have a crystal ball.
You don't need a crystal ball. What you need is a way to think about value. Start by asking yourself, what are the big stories everyone's telling? What are the companies everyone's ignoring?
Okay, so find the companies that are like out of favor.
Right. Then dig deeper, challenge those stories, look for evidence, and ask yourself, what if everyone's wrong about this?
It makes sense, but how do we know if it's a good idea or just like a crazy idea?
That's where the hard work comes in. Analyze the company's financials, learn about their industry, see who their competition is, try to figure out what their future looks like.
So like be a detective, gather the clues, but even then we could still be wrong, right?
Absolutely. The market doesn't always make sense. That's why it's important to diversify. Don't put all your money in one place. Spread it out, reduce your risk. Investing is a long game. You'll learn as you go.
So to wrap things up, what's the one thing you want our listeners to take away from all this?
Think for yourself, be a little skeptical. The market is always changing. There are always new opportunities. Stay informed, stay curious. You might just find the next hidden gem, the one everyone else missed.
All right, so that's our deep dive into Roaring Kitty's GameStop analysis. Who knew a video from 2020 could be so relevant today?
It just goes to show sometimes the best opportunities are the ones hiding in plain sight.
And on that note, we'll catch you next time on The Deep Dive.